The concept of forever funds. An illustrative example. Consider a hypothetical retired couple, whom we'll call Joe and Lisa, to help elucidate key concepts about retirement funds. They're not real individuals, but constructed personas intended to bring to life the principles at hand. In our scenario, Joe and Lisa require $95,000 annually for their expenses. Their current income includes $30,000 per year from Social Security and $15,000 in annual dividends and interest earnings from Joe's retirement fund. To fund their annual budget of $95,000, they must supplement their income with an additional $50,000 yearly, withdrawal from Joe's retirement savings. Given these circumstances, how large should Joe's retirement fund be to allow for an annual $50,000 withdrawal for at least the next 25 years? With a 4% annual withdrawal rate, Joe's retirement fund should total $1,250,000. This amount would last for 25 years, assuming there are no interest earnings or dividends on the remaining retirement fund. However, if Joe's retirement fund were invested in a diversified portfolio, 55% in equities and 45% spread across fixed income securities such as U.S. government bonds and U.S. treasuries, as well as U.S. government money market funds, this configuration could potentially yield around 5.3% annual growth. As a result of this asset allocation, the remaining capital in the portfolio could grow incrementally over time, ensuring the $50,000 annual withdrawals become sustainable for a period extending well beyond 25 years. This model assumes an average annual return of 7.5% from equities and 2.75% from fixed income securities such as U.S. government bonds and U.S. treasuries, as well as U.S. government money market funds. In this simplified ideal context, Joe's retirement fund could evolve into a growing, forever fund, as the 4% annual withdrawals would be less than the projected 5.3% annual growth. Remember that this ideal scenario is highly simplified, designed to provide an illustrative model to highlight the underlying principles. It doesn't account for significant variables such as annual inflation, tax implications, stock market fluctuations, interest income variance from money market instruments, inconsistencies in dividend yields, major health concerns for the couple, and other influential factors. Through careful planning and judicious investing, it's possible to build a retirement fund that can sustain a retired couple well beyond a 30-year period, potentially allowing the forever fund to be passed on to succeeding generations as the gift that keeps on giving.